Welcome back everyone to another edition of Insightful Principles. In today's video, I want to discuss, are we in a housing market bubble? Kind of giving you all some of my expectations for the housing market throughout 2023. And throughout this video, I am going to break down some charts that's really showing that we may possibly be in a further bubble than what we seen during the great financial crisis. So I'm going to break down what are some of the trends with the housing data with Realtor.com, as well as going through some information that I found with the National Home Builders Association from some of the research I did online. So definitely stay tuned. This is going to be a very good video, just kind of breaking down what to expect within the housing market and kind of looking at the landscape of how demand is starting to go down a lot more within the housing market. But as always, if you all can do me a huge favor, if you could please like, subscribe, and share this video. Don't forget to hit that notification bell below so you can be notified every week when I drop content. Now, currently right now, the 30-year fixed rate for mortgages is somewhere between 6 to 7%, and for the 15-year fixed mortgage is a little bit lower, around about 5.5%. And this is the highest increase we have seen since 2002. However, with looking more historically with how interest rates have affected mortgages, back in the 1980s, mortgage rates were actually above 18%. So we're certainly not nowhere near that point right now. We're halfway there, but I don't think it'll get that high. But in this type of, market, you never know. But nonetheless, I think that the cost of debt is becoming much more expensive. The cost of borrowing is much higher right now, and it has really impacted some of the demand within the housing market. Now, according to Realtors.com's December housing data for 2022, the number of homes for sale have increased by 54.7% compared to last year. So this means that inventory has been up. And the data also showed that home sellers are less active this year. And it actually showed that 21.0% fewer homes are being listed for sale compared to last year. Now, some of the reasons for this is because, sellers are observing how interest rates are right now, and many of the challenges of what sellers are experiencing is if they should sell their home right now or if they should possibly wait at a later point when interest rates start to normalize. Because one of the biggest decisions that people are having to make is, do I sell my property right now and risk the fact that the next property that I'm going to purchase is going to have a much higher interest rate on a property that they currently have now? I mean, you can only imagine for the people that bought mortgages in 2020, 2021, when you could get a 30-year fixed mortgage rate from somewhere between 3 to 4%, you don't want to risk having to sell that locked-in mortgage rate to have to experience a higher rate in the market with the cost of debt being much more expensive. So a lot of people are hesitant, and buyers and sellers right now are at a standstill because they're not really sure what to do. You have buyers that are not necessarily wanting to buy properties right now because they're noticing that interest rates have been going up. And I'll kind of talk about, what are some different strategies and approaches to this type of market and how to kind of really view it. But I definitely think sellers are really experiencing that right now. And another thing that I think is, it's just a very different macroeconomic environment. We're dealing with an environment where our Federal Reserve is starting to be much more aggressive with their take with raising interest rates. And it's a lot different landscape than how it was in 2020 and 2021 when we had a lot of different quantitative easing going on where the Federal Reserve was keeping rates very low. Now, some of the other notable trends that I noticed with looking at some of the housing data for Realtor.com was they talked about how Milwaukee, Memphis, and Miami were the three highest price appreciating areas compared to all the other states over the last year. So it showed how over the past year, Miami actually increased by 20.4%, Milwaukee was 46.2%, and then Memphis was 34.0%. So I thought that was pretty interesting with seeing that you are going to have different areas that are going to appreciate, even though demand has been going down. There's still people that want to live in these areas, and especially when you think about when we had the pandemic, how a lot of people from California were moving to Texas and people from New York were moving to Florida. It really just goes to show that people are going to move to the places where they can have more tax advantages. There's going to be a better quality of life, and that the person just genuinely feels that this is a place that they feel that they can build the foundation, or maybe they're an entrepreneur and it's a pro-business friendly environment. When you talk about Texas, when you talk about Florida, when you look at Memphis, Tennessee, all of these different areas, I can see why price appreciation in some of these areas have done well, because people at the end of the day, regardless if the economy is on a downward turn, they're going to go to the areas where they feel that they have the best advantages. And a lot of people have migrated from areas that cost a lot more with state taxes. When you think about California and New York, places like Florida and Texas, there's no income tax for the state tax. So these are some of the reasons of why I think that you are going to continue to see some highly appreciated areas throughout the economy, but there's certainly going to be areas where people are going to move away from those areas, and they're going to continue to see a little bit more recessionary pressures. Now, I also think that right now we're in an environment where households are simply being priced out of the market. And what I mean by that is that mortgage payments have increased from $1,925 on a median price new home in early 2022 to now it being $2,923 on the same house. And this is a 51% increase. And I want you all to look at this chart that I have here. I actually found this chart off of the National Association of Home Builders, and they really just kind of break down that this is the U.S. households being priced out of the market by the different increases of what we've seen with interest rates. And as you can see here, when we had lower interest rates a few years ago, when rates were somewhere around 3.22%, the monthly mortgage payment on a home that cost $450,700 was only, like I mentioned, $1,925. And the minimum income needed to be able to be approved for this type of mortgage was $104,302, and at that time only 34.2% of people were able to purchase this type of home. Now, if you look all the way at the far end of the column, when you look at the mortgage rate increasing to 7.08%, you can see how on the same price for this home, mortgage payments just from a 4% increase with interest rates has raised the monthly mortgage payments for a lot of people to $2,923, almost $3,000. And the minimum income needed has moved from $104,000, give or take, to now $147,000. So you're talking about almost maybe a $42,000, $43,000 increase just off of a 4% increase in interest rates. And as you can see, where it shows the households that can afford this type of mortgage has went down to 20.3%. So that just kind of shows you just how the monetary tightening that we're seeing, how it's affecting the demand within the housing market. Now, before the peak in 2007, the equity in people's homes at that time was around $15 trillion, while mortgage debt was only $9 trillion. And when we had the subprime mortgage crisis that happened, where a lot of these loans that were being lent out by these different investment banks, these different mortgage lenders, whether these different financial institutions that we had, when all of that collapsed and the people were no longer able to afford the loan, because keep in mind, these loans that were being lent out, you had loans that had no income verification procedures, and a lot of these loans were really just given out with a blindfold, and they really didn't care what type of financial condition you were in. They were lending out these loans for these mortgages. And when the whole system collapsed within the housing market, when all of these bad loans collapsed, what happened was you really seen that people's homeowners' equity flipped from positive to negative. So that $15 trillion that I mentioned, how people equity was at that time, but the mortgage debt was $9 trillion, it had flipped. And now you had people that were upside down on their mortgage. And one thing that I want to show you all, and I actually found this, I was listening to George Gammon, which I don't know if you all have heard of him, but he's a very intellectual guy. He's a real estate investor. He talks a lot about some of his experiences of investing in the market and how he actually sold a lot of his investment properties like sometime last year, beginning of last year, into 2021. He really talked about this article that was on Zero Hedge, where it was really highlighting how the bubble that we're experiencing now makes the bubble in 2008 actually look far small in comparison to what the bubble can look now when it actually bursts. And actually, when you see here, kind of when I talked about how that red line here is showing the households that have their owners' equity in real estate, how it's much higher in comparison when you look between 2007, 2010, and that black line below it is the total mortgage debt. So you can see right now in 2022, there's a much more higher equity that people have in their homes in comparison to mortgage debt. And many people will argue that we are in a bubble right now and that is much larger than 2008. We may not be dealing with a crisis when it comes to subprime mortgages because a lot of lending protocols have become much more restrictive. I still think that this can also cause things to unfold within the market where you think about how a lot of people that actually bought homes a few years ago, they might not financially be able to afford their mortgage right now if, with these changes in interest rates. Now, if you have a fixed mortgage, you're perfectly fine, but I'm talking more for those that have a variable interest rate where their interest rate may be much higher than this 7% that I'm showing here. So I think that it's affecting a lot of people in different ways, but even the people that are locked in with a lower rate, a fixed rate, a lot of questions that they're having is with their home values. And I think this is the constant psychological battle that you're going to have with sellers within this market, in the housing industry, is they're starting to question, should they continue to hold their home if it's going to continue to lose value as far as these interest rates start to go up. That's going to cause home values to go down. So a lot of people may be looking at it from a perspective, if I bought, low for my home property, I may want to sell at a higher amount now and kind of be able to take my profits. But then again, I think that real estate is a price appreciating asset. So I don't necessarily think, in this type of market, you have to just go about selling it, because if you're planning to hold your property over 20, 30 years, I look at it simply from the same mindset as when I'm investing in stocks. I want to be able to buy something that's undervalued, and I want to hold it for as long as possible, because I understand that these are assets that are designed to go up over time. So even though we may deal with some market volatility, or we're dealing with higher interest rates that are going to bring home values down, if it's not more of a fix and flip type of strategy for yourself, I don't necessarily think this is a time where you necessarily have to sell. Buying and holding, there's a lot of value in that, but I definitely can understand that a lot of sellers right now are probably thinking, should I sell now and collect the profits that I do have, or do I take the risk on waiting down the line to sell, and my home could be valued much more less than what we have now with the tightening that we're seeing with our interest rates. So I definitely think it really presents a lot to think about for sellers right now in the housing market. And right now, when I talk about that comparison with homeowners' equity compared to mortgage debt, right now homeowners' equity is at a staggering $30 trillion, and the mortgage debt has increased to $12 trillion. So that just goes to show you the type of spread that we're dealing with now. Can you imagine if we continue to see further tightening and these mortgage payments only start to go much higher? The equity, if this bubble does burst, it could also flip, and you can now have a situation where people are upside down on their mortgages, and they bought mortgages that they not necessarily can afford. And I read something online that really talked about how the type of mindset you want to have in this market is you want to date the rate and you want to marry the mortgage. And what they were trying to say when I was reading this article is pretty much in this type of environment, of course, if you're looking to buy a home, you have to kind of take it with a grain of salt that you typically are going to pay a little bit more as far as with your down payment on your property because interest rates are higher. But at the same time, you can always refinance at a later point when interest rates go down. So you're, in a sense, you're dating the rate temporarily, but you're marrying the mortgage from a standpoint of you're locking in an appreciated asset that you know that's going to grow over time. And real estate is a cornerstone when it comes to building wealth. So you want to have that as a foundation when it comes to building assets around your financial picture. So I think that you can look at it from both ways. I understand people that may want to hold off on buying a home right now, but I also think that, getting in the market and being able to find an appreciating asset that will go up over time, I definitely think that it's a good thing as well. And the median sales price for homes right now, as of quarter 3 of 2022, which it kind of shows you right here, is $454,000. And many millennials that actually bought homes during the pandemic, during the post-pandemic, are really questioning if they rushed into buying their home or maybe if they even overpaid for their property. I mean, can you only imagine? It's almost, in a sense, I'm glad to see that home values are going down because it now gives the investors more opportunities to actually get in where there's not a lot of people in the market. So you're not having a lot of challenges with being able to compete for deals. And it just gives us more opportunity to be able to see more stability within a market where these prices are starting to go down. So I don't necessarily think it's a bad thing. But according to CNBC, they talked about how the number one reason for buyers' remorse is that they spent too much on their first home, while the second most common regret was rushing into the home buying process. So far what we are seeing in the housing market is that sellers and buyers, like I mentioned, they're simply waiting. We're dealing with, recessionary pressures as well as a lot of uncertainty of what's going to happen in the housing market, when the Federal Reserve is going to, pause rates or how long they're going to continue this aggressive take on raising rates. And I think that a lot of these interest rates are pricing people out of the market. But also, I think that sellers are really trying to determine when is going to be the best time to sell their home. And I think that if market values do continue to go down and you see more households lose equity in their home, sellers may end up rushing into the market, and this could be a catalyst for an increase in inventory levels with homes within the market. But I think overall we are seeing a gradually cooling market with the demand going down. And I think that this really gives buyers more time to be able to make a sound decision when it comes to purchasing their first home or purchasing their, second home or their next property. But I definitely think, with the increase in interest rates and home values coming down, this could help stabilize the housing market to a certain extent. But overall, I definitely think the direction of inflation, the Fed tightening with interest rates and economic growth is ultimately going to affect what happens to the housing market throughout 2023. But I thank you all so much for watching this episode. As always, if you can do me a huge favor, please like, subscribe, and share this video. Continue to share this with your family and friends. It's greatly appreciated. And it's going to be much more informative content like this, where I'm going to continue to keep breaking down different sectors and really giving you all some insight on what are my expectations, what are some ways to really think about how everything in our economic environment is playing a role with stocks, with real estate, with crypto, with precious metals, with people that actually have their own businesses. So I definitely appreciate you all taking the time to watch this video. Don't forget to hit that notification bell as well below so you can be notified each week. And I thank you all so much for watching, and take care.